Welcome to the Unsexy Entrepreneurship Podcast. Everything you need to know for millennials looking to start, acquire, or grow a business with CPA and entrepreneur Charles Harris and director of the Entrepreneurship Institute, Dr. Seth Jenson. This is the Unsexy Entrepreneurship Podcast.
Welcome to the Unsexy Entrepreneurship Podcast. I am your co-host, Charles Harris, and as always, I'm joined by Seth Jenson. Good to be here, Seth.
Yeah, it's a good day.
So today I wanted to talk about something that I get asked, at least once a month and sometimes multiple times by the same person because it just terrifies business owners. And so as part of this, we're going to call this, what are we calling it again?
Actionable Insights. Is that what it was?
Yes, I think so. If not, it is now. So this is the first week of Actionable Insights, and this is a series that we're going to be doing in and out of other weeks. The 0 to 1 series has already started, and this is just slotting in. And so we're going to slot some of these actionable insights in throughout different things, mainly just when we have something that we want to talk about that needs to be talked about. And this is one of those topics.
Yeah, this is one of my favorite things about what we do, because every business owner and every would-be business owner, they have these like lingering questions, either nagging at them that they know they should have figured out and they haven't, or that's kind of keeping them from making the dive because they're like, I don't even know how to do this basic thing. And so like, I'm scared to even start, right? And so these are kind of just little tidbits that help you form a strong foundation for your business so that you can feel confident that you're not only building something that's going to sell and be valuable, but that you're building a business that is sound financially, structurally. And so these are just things that are like, yep, if you're already working in this space, you can make sure you're doing it right. If you're about to, you can make sure that you proceed with confidence. And so I love this segment.
All right. So we're going to get nitty gritty here a little bit. This first one should be obvious, and hopefully I've said this on multiple podcasts, but have a separate personal and business bank account. So what we're really focusing on today is how to be able to pay yourself. And that sounds really silly, but I think a lot of entrepreneurs come from working a W-2 job and they're used to just getting a paycheck in the bank. They don't think about, where is this money coming from? Is it my money? Like, am I allowed to take this from the business? I've heard all the above plus others. So the first step in order to pay yourself is to keep a separate business and personal. And if I haven't said that, I'll say it again, and I'll say it a million times. Keep them separate. Bank accounts are cheap, if not free. So just do it. It'll help everything. And it also helps, I think, differentiate from the business has money in the bank versus I have money in the bank, which are different things. And as we talk about how to pay yourself, it helps to differentiate the two.
Yeah. So I've got a question about that, Charlie. So
yeah,
we talk about on this podcast a lot about in the very early stages, like the first thing you do in your business shouldn't be set up a business bank account, shouldn't be doing an LLC. You need to wait till you've got your first sales in there to make sure you've got the direction solidified. So if someone's in that stage, what should that look like pre-separate business account? Once you've got that direction, you should definitely have a bank account, but you need an LLC or whatever type of corporation before you've got that business bank account, right? And so pre-incorporation and pre-business account, what should we be doing with the money that comes in? Like, how should we be thinking about that money?
That is a great question. I would keep a very, very, very accurate Excel spreadsheet. And it's hard because the second you get 20 sales in a month, that spreadsheet is going to be off. I know people and I know how it works. So it needs to be a pretty quick turnaround once you're really like going for it. But for those first 10 sales, don't set up a business bank. Don't get an LLC. Just make the sale. I think that's really important. But record every expense, every revenue that you get. As soon as it's more than, I would say, like 10 transactions in a month, you need to have a business bank account.
And to be clear on your taxes, is that just coming out as extra income? That's where you're going to look at that spreadsheet and make sure you account for that income in kind of that section of your tax form, kind of the extra income?
Yeah, it depends. I would probably put it under hobby rules, which would be Schedule 1. Sorry, we don't need to go into that. But yeah, it would be other income, basically. Like you have to pay taxes on gambling earnings or windfalls, right? So like the lottery. So this would fall into a similar position. Once you're kind of more convinced that this is really going to be a business, that's kind of when it would fall under a Schedule C, which would be a business. Sorry, I'm probably using more accounting words, so please bear with me.
Great.
But I hope that makes sense.
So the principles here: keep super careful track of it, and know that it will be taxed, and you're going to need to make sure you account for it in your.
The nice part is you can deduct expenses for the business if you're earning money, right? So you got to be careful. You can't just say, hey, this is going to earn money one day. I'm going to buy a new HD camera and I'm going to buy some lighting and microphones. Like that's not a business. But if you're consistently bringing in money, then I would lean towards probably starting it off as a hobby on a Schedule 1. And then if you're more sure that this is going to be a business long-term, that's when I'd get a business bank account. It would move to a Schedule C. And for hobby rules, you can't have a loss. So that's important to realize. And that's why I say it would probably fall in there. So again, always try and be at a profit if you can, even on that first sale, which I know is really hard, but try.
And this is probably a good time to remind people that this is not financial advice and we are not your legal representatives in any way. This is entertainment podcast. And so, go hire a great accountant like Charlie to take care of this, or do the work to know for yourself how to handle this stuff. Okay, so that's great. So that's how to do it before you
walk you through that.
Yeah. There's cheap software too if it's simple. So that's how to deal with the pre-LLC stage or S corp or whatever you're building.
Yeah.
But then what you're telling me is as soon as you've got that entity built up, go get that separate business account and keep them separate as soon as possible.
As soon as possible. And, sometimes it's before you're starting to really make a lot of revenue, if you can see kind of the writing on the wall. And then once you have it, now we can talk about what is salary and how do you pay yourself? Because this is the question I get so often. So we have these two distinct entities. We're used to a W-2 sending money straight to us. And so now that we're responsible for transferring the money, we get a little nervous. Like, can I transfer this money? Does that mean it's going to be taxed? And all of these different things. Again, your situation could be different, but generally speaking, when you form that first bank account, you're usually an LLC, a proprietor, and that's not a tax designation. So we're not talking about S corps, which you've probably heard about, which is a whole other discussion. And when you're an LLC or a sole proprietorship, it's something called a pass-through. A pass-through is just the fancy word for if your business earns money, you earn money. So what I hear often is, hey, if I transfer money to myself, I'm going to get taxed on it. So I'm going to avoid sending money to myself to avoid taxation. Doesn't work. You're still taxed on that money because it's a pass-through. Your business is yourself as far as tax purposes go. So when can you send yourself money? And the answer is usually when you have money. I usually coach people to have 3 to 6 months of expenses saved up in their business bank account. And then anything above that, feel free to transfer to your personal account. And that's what we call a distribution. So you're not actually receiving a salary. Distribution is the fancy accounting word, and that's just receiving money from your business. And so it's important to know you still have payroll taxes on distributions. You still have normal federal income taxes. Really, there's no difference between that and your W-2, except with a distribution, it's not withheld. And so you have to be responsible for paying your quarterly taxes, for paying your taxes at the end of the year, which everyone hates, but it exists.
So let's bring this to an example. So like, let's say I have a consulting gig and they pay me $3,000 and maybe I spend 100 of it on materials for that. So I'm sitting there, well, we'll say 500 for easy math. So I'm sitting with 2,500 in my bank account and I decide I want to hold 500 in the bank account and pay myself 2,000. You're telling me that I'm not going to actually get to keep $2,000. I've got to plan some of that 2,000 to go towards these kind of federal and state taxes.
Yeah. So the full 25. So let's say you spent the $500 on expenses. The full 25 you're going to get taxed on. You're going to transfer the 2,000 to your personal account. And once it hits your personal account, you still have to pay taxes on the full 25. There's no difference between the 2,000 and the 2,500. And at that point, you have to do withholdings and all of that. In your situation, because you have another job, you already have withholding taxes being held. And so that's a whole different situation, right? And so again, this is not personalized advice, but just general rules of thumb.
So I guess the point though is, if I need 500 in that to stay in the bank, all those taxes are coming out of that 2,000, right? And so I've got to be prepared. It's not going to be 2,000 going home. It's going to be 2,000 minus that 2,500 worth of taxes being pulled. Do you have a way for people to estimate this easy? Are there ways online that you can?
Yes. NerdWallet has a great one that I'll use. Again, general rule of thumb is between 20 and 30%. It's going to depend on your prior year taxes. And hopefully a CPA can go through and actually tell you exactly how much you owe. If your CPA isn't telling you how much you owe, then that's a problem. But it is really guesswork until we end the year. And so we'll talk about estimated taxes at some point. But generally speaking, your estimated taxes aren't going to change because they're based on prior year's tax return. So all this extra money you get, I recommend 20 to 30%, set it aside in a savings account because you're going to need it for taxes.
That's super helpful.
But it's going to depend, right? So if you make a lot of money, 30% is more likely. If you make less money, 20% is more likely. Generally, that's where I say if you're making millions of dollars, do 37%, right? That's the highest tax bracket. But generally, 20 to 30% is correct. So the next thing I kind of want to talk about is the difference between profit and revenue. So we talked about we are able to take that $2,500 from us. And I'm going to keep using that example because it's a perfect example. We made $3,000 in revenue. Only $2,500 is going to get taxed because that $500 is an expense for your business. It's allowed to be deducted from your taxes. So you won't get taxed on that amount, but you'll get taxed on the $2,500. And so I
think we should imagine that $500 being spent on something exciting. Like I got a plane to write my company's name in the sky for marketing purposes.
That's exactly right. And that'll make a huge difference in their bottom line, I'm sure.
Yep. Trust me, I have a strategy PhD, so I know how to market my business well. So 500 for skywriting. Continue.
Yeah, 500 for skywriting, and then 2,500 is our profit. So you'll hear people toss around revenue, profit, gross, all these different terms. 3,000 is your revenue or your gross amount. 2,500 is going to be your profit or your net income. The accountants in the world will use net income. Pretty much everyone else will use profit. But it's important to realize, hey, that's the money that you can take, right? So if we're in Seth's situation, we're going to leave 500 in the business for future marketing, for more skywriting.
Exactly.
We have to have that skywriting. But that $2,000 is our salary, right? So we're paying ourselves with our business, and that's how much we're getting. That's our distributions. We're saving some for taxes, but we are very happy with that.
And practically speaking, you're saying when you say save those for taxes, it's just going to sit in my bank account until that tax time of the year, right? Like I should have that.
I recommend paying your quarterly estimates, right? Which we haven't talked about here and we probably won't. But anything beyond the quarterly estimates, stick in a high yield savings account, something pretty safe that's going to earn a lot of money or earn more money than sitting in a bank account, right? That's kind of what I would mean. And so ideally, I mean, you could even put it in the stock market. I'm not going to say that because it's technically not your money, right? It's going to leave your account at some point, but you could even put it in the stock market if you're feeling risky. And so there are a few things that I want to touch on that I've seen as issues in the past and hopefully some solutions for them. Number one is cash flow. And so this is a fancy word for knowing when things are going to happen. So for instance, I have a practice management software. It costs roughly about $1,000. It'll be probably more next year, but I know that expense is upcoming. So for Seth, for instance, let's say he contracted out to do 2 skywriting events for 2 different companies. He made $3,000. He's expecting another $2,000 when the next skywriting happens, but it hasn't happened yet. He can't take out $2,500 because then he would have no money for the skywriting. Suddenly you'd overdraft or you'd need to put it on a credit card, which is a whole different discussion. So my usual recommendation is to kind of know what your expenses are upcoming.
Yeah.
So that's cash flow analysis. That's a whole other thing. And that can get really complicated really quickly. If you're small, if you're just starting out, if you're at that 0 to 1, it's really easy to do cash flow forecasting. And so do it. Know what your expenses are every month, know what they will be in the future. And then you can take out the extra money. I would leave a little bit of a cushion, but take out the extra.
Yeah, for sure.
And then the other big thing that I think is a helpful tool to account for salary is to make it consistent. So when you work for a company, it's consistent. You're paid a salary range, right? So they're going to pay out every month the same amount. I recommend for small businesses to do the same. And this is maybe going to a little bit of a profit first approach, but I think it's helpful to realize, hey, I need this much money to live, to subsist. So I'm going to make sure I have at least that much. And then the extra I can use. Let's say Seth could live on $1,000 a month. We know that's impossible, but let's say he could, right? So we know he needs to take out $1,000. He spent $500 on, what is it called again? Air writing? Skywriting. Sorry. And then we know another expense is coming up, skywriting, another $500. Let's say Seth loves this marketer. He's like, oh, this guy is awesome. He is going to be able to bring me 6 new clients, but I have to go schmooze him, wine him and dine him for $1,000, right? So suddenly that $2,000 he was going to take away with 500 safe is now 1,000, and it's really, really tight. So, it's just important to realize, like, what do I need to live on? Where am I? And then how to calculate that going forward so that you can take out what you can in your business while still leaving the necessaries in there.
I love that because, again, being consistent is motivating because as you watch month after month your business grow, then you can change that consistent number, right? You can up it, but in a way that's responsible.
Absolutely.
And that's highly motivating as a business owner. You realize, okay, if I can increase the cushion and I see that okay, my cash piles are stacking up in my bank account, then I'm able to pay myself more. That's highly motivating to get out there and get a consistent revenue stream increase, right? Not just going after ones and dones, but what can I do and invest in my company now so that I've got sustained growth in the long term, so I'm able to just really comfortably continue to pay myself more. That kind of mentality that's a growth mindset as opposed to just waiting and opportunistically pulling out money when the bank account's big or small, right? So
and I've seen that, right? I've seen entrepreneurs hoard their cash until they have $200,000, then come up to me and ask me this question is like, can I pay myself? And I say, yes, you have more than enough cash in here. And so then they pay themselves $100,000 that year, right? Or that month, which is just mind boggling to me that they can live without paying themselves so much. But
yeah,
I think that's really why I wanted to talk about this, because I just see it so often and it's such a big worry. And I understand it seems scary and you're worried, oh no, if I take this money out, I'm going to get taxed on it. How does this work? And so that's why we're talking about this. So then the last thing I want to touch on is exactly what you're talking about, is the growth mindset. So I'm going to use my own business for this. I'm hoping to bring on a tax accountant by the end of this year, early next year, mainly so that I can have help during tax season, which is a little terrifying. The pros of that is that I can have a ton of wiggle room and I can do more marketing and do everything else that I do. The hard part is it's going to eat into that cushion that I've built, right? And so again, I'm doing the same thing that we've talked about. I have said I need this much money to live on, and that includes taxes. So it's a little bit more than you would think, right? And then I'm saying as soon as I earn monthly this amount more, I can hire that person. And that's how I'd want people to approach it, especially in my situation where I'm living comfortably. I have a good life. I have a good salary. It's hard to complain. I could take a lot more money out of my business. But what I've seen too often is people hire aggressively and then they don't make any money themselves. And then suddenly they're in a worse spot than they were prior to hiring. And so to Seth's point, we've got to plan for that growth. We've got to plan for taxes. You have to know your cash flow. You have to know when cash is going to leave, when expenses hit. And overall, after all that's done, take money out of your account. It's your money. You've earned it. You've done a great job. You've created a product or a service that people are paying for. And so take it. Enjoy your money.
Yeah. No, I think it's so This hits home because recently I had a student who was working multiple part-time jobs while building this business that was cash flowing quite well. And she was like, oh, like to meet this demand, I really need to hire out more people. And I'm like, why don't you just do it yourself and pay yourself? Like, she was literally working a job and then considering hiring someone because she didn't have time because of working this other job. And I was like, you can quit those jobs and pay yourself from this revenue and do it. And she hadn't realized that was really an option at this stage of her business. And exactly what we talked about today would have been that unlock for her. And luckily I was able to point her in that direction. But it's so important to understand this stuff. And so, yeah, I'll try to review kind of what you've covered and let me know if I missed things here.
Okay.
So we're talking about how to pay yourself, right? You're in those early stages, or maybe not. Maybe you've got a company that's established. You want to start, personally benefiting from it. First thing, make sure you separate your business and your personal accounts so that it's very clear what's business money and what's not. And that doesn't gunk up your cash flow statements and all these things we talked about later. We talked about how what you're getting is a distribution, not necessarily a salary, and that you've got to consider things like the taxes that will be attached to that distribution. So again, you might have money set aside for your business for, growth or future expenses. You should, but that what's left over isn't all going to end up in your pocket, because some of it you need to set aside for taxes at the bare minimum. And we talked about how you can find estimators on sites like NerdWallet to be able to kind of forecast that. We talked about how you really need to be thinking about your net income or your profit, not your top line revenue figures. And it needs to be coming from that net income, and that you've got to be aware of that expenses coming down so that you don't pay yourself money that your business ultimately needs. And then you find yourself in a bind because of cash flow constraints. We talked about the power in having a consistent distribution over time, and then, setting goals so that you're able to increase that distribution because you're growing that revenue and your profitability. And don't ignore your taxes until April is kind of the big implied conversation happening exactly right here. You should be thinking about this all along the way so that you're not surprised when taxes come due. Did I miss anything?
That is perfect. That is perfect. And then pay yourself. It's your money. Keep it. Enjoy your money. You've earned it. Too many entrepreneurs are scared to have any money. Anyway, thank you for our insightful time here, our actionable insights. We're really excited to kind of bring them to you. Hopefully, if you have any questions on this or any other accounting or business topics, let us know and we can make these an actual insight. And thank you for listening to the Unsexy Entrepreneurship Podcast. Thanks for listening to the Unsexy Entrepreneurship Podcast. Seth and I want to continually improve and make sure that we're covering the topics that you as an entrepreneur really want help with, but we need your help with that, and here's how. So first, please like and subscribe to the show wherever you're getting your podcast. We want this to get into as many hands of entrepreneurs as possible. It could really help make their business a success. Secondly, leave us a review on your podcast app. We read each and every single one of those comments, and it really helps us in our planning to make this tailored for you as an entrepreneur. And lastly, send us your questions directly. Just click the link in the episode description and you'll be able to contact us directly, as well as get notified of upcoming shows and value-added content. So we look forward to hearing from you, and we'll be back next week. Thank you.